I'm telling people, stick with the American consumer, stay in things like mortgage-backed securities, preferred debt from these community banks, because the consumer is going to not consume over the next 2 quarters, let's say, and so they'll be spring-loaded coming out of this thing. I'm more cautious about the equity markets. Ray's had a tough time the last year or so, but he's obviously a brilliant investor, so I don't want to second guess him. But the reason I'm so cautious about the equity markets is that it's very difficult to forecast what 2020 and 2021 earnings are going to be. Let's assume that the Fed is going to aggressively expand their purchasing program and go into QE 5, 6, and 7. That'll be good for equity markets, but I do think there'll be time to buy those markets, because if the Fed is expanding its balance sheet at a time where the government is announcing a 14 to 21 day quarantine, which is not impossible, the market will get very, very sloppy into an environment like that. So I think Ray Dalio will be right long term. Markets will rally back. This is not a systemic banking crisis. This is going to require a global coordination on the fiscal side, where governments around the world are going to have to help small businesses and restaurants and people in the travel and entertainment business. All of these businesses that are being shuttered right now for a 1 to 3 month period of time are going to need some help from the capital markets. It would be easy for the U.S. to borrow at roughly zero and extend those loans to small businesses at roughly zero, which I think would really help out the markets. But I think there's time here, Hadley. And so I'm more interested in the distressed bond market and what's going on in energy bonds, both investment grade and high yield, than I am the equity markets right now.
I just want to jump in with a question specifically related to earnings. How significant do you think the downside pressure will be to earnings going forward over 2020? Because when you look at some of the companies you just mentioned as well, United Airlines cutting 50% of its capacity, American Airlines 75% of its capacity. So the hit not only to those companies, but also the associated feed companies is going to be significant. How significant do you think?
So I think that's a great question, and what I would tell investors to do is go through the balance sheets of those companies, look at how levered they are, look at their refinancing capabilities, how much cash do they have on the balance sheet to get through this 3 to 6 month period of time, and the ones that are the most well fortified, those are going to be the ones that certainly survive and shoot upwards after the crisis. But again, you're making my argument for me why there's going to be so much sloppiness in the market over the next 3 to 6 months. I don't think the investors globally have fully priced in the extent of a shock where you sort of have a standstill in the global economy for say, let's call it again, a 3 to 6 month period of time. You're not going to have a V-shaped recovery from that sort of a recession. It'll have sort of a flattish U period as these companies and investors readjust. So you just made another very smart argument for why many people should get to the sidelines right now.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.